The legendary company run by the Warren Buffett of Canada, Mark Leonard. The company that in the past decade alone has achieved 24% CAGR in revenue, 31% CAGR in operating profit, and 27% CAGR in free cash flow, with similar numbers, if not better, since IPO in 2006. Constellation Software has always been seen as one of the highest quality companies to ever exist, one of the best run companies with one of the widest moats and best returns on capital. However, it's lost more than 50% since its peak, which is a massive drawdown. Despite being down this much though, it's still up nearly 15,000% since IPO in 2006. And there's mainly two reasons to explain this massive drawdown. But most importantly, deteriorating fundamentals is not one of them, or at least not yet. So what are those two reasons? First of all, the fear that AI will disrupt their business. And secondly, Mark Leonard, the Warren Buffett of Canada, having to step down because of some health issues. In this video, we're going to go through why Constellation Software might actually be much more resilient than what the market thinks with regards to these risks, and as well perhaps others, and therefore why it might be wrong for selling it. In my opinion, I think that Constellation is one of the best, if not the best, software as a service company best positioned to benefit from AI and to be resilient from it. In this video, we'll first get a brief overview of Constellation, then we'll focus on the two risks already mentioned, but also a third one, which personally is the one I'm worried about the most compared to the other two. Then I'll also explain the weaknesses of investing in Constellation, which all investors must be aware of. And finally, we'll have a look at the valuation of the business, which is by far the most important thing in this case. Of course, I'm for sure going to leave out some details because there's so much to say about this company, so let me know down in the comments if you want a deep dive. Before we move on, just in case you don't know who I am, my name is Paul Gante and I work in asset management as an equity research analyst on the buy side. Now, getting back to Constellation, for those of you who aren't familiar with the business, they're essentially an investment vehicle just like Berkshire Hathaway, where they grow by acquiring hundreds of companies each year. However, they specialize within the vertical market software segment, only buying very small companies. Now, vertical market software, VMS, is very specific and mission-critical software that tends to serve one main purpose, as opposed to horizontal market software, which could be like Microsoft Excel, for example, which can be used for many things. Vertical software, the kind Constellation specializes in, is software that helps small businesses, like for example, in chicken coop management, or in cemetery management, or dental clinic software. But importantly, a very large part of their portfolio of companies are within segments that require a lot of regulation and a lot of compliance. So for example, heavily regulated utilities, or in the financial sector like banks and things like that. The founder, Mark Leonard, essentially found out that by focusing on acquiring companies only worth a few million, they could essentially have no competition because there just wasn't enough money at play for the big dogs to be interested. And therefore, by paying a reasonable price, no matter the business, they could get really high returns on capital. Now, Mark Leonard can be seen as a value investor because essentially the whole acquisition strategy was focused on buying companies for quite cheap, at low multiples, no matter the quality of the company. Now, they don't care whether the company is actually growing or if it's not growing or even decelerating, if it's high quality or not high quality. All they care about is the return on the investment. And you might say, well, that's not great, right? Acquiring low quality companies. And that's actually one of the main criticisms that Constellation faces. But let me show you with an example why actually it's a pretty good strategy. As you can see from the table, here we have a not great company. Essentially, sales are going down each year by a meaningful amount. Free cash flow margin is also decreasing. So it's essentially a dying business. But as you can see, Constellation can still get some decent free cash flow out of this. In total, if Constellation were to buy this company and milk all the free cash flows during those 7 years, they would be able to get out 128 in free cash flow. Therefore, depending on the price that you pay, this could turn out to be a pretty good deal or a bad deal. Again, if we look at this table, looking at the different price to sales multiples that you could buy the company for, if you buy the company for a good enough price, for example, 0.7 price to sales multiple, well, you can get a 33% internal rate of return, which is truly amazing. On the other hand, if you don't pay a good multiple, for instance, a 1 times price to sales multiple, then the IRR is only 10%. So essentially what I'm trying to say is that one of the common criticisms of Constellation is that they buy companies that are just not good. But actually, that doesn't matter. That's irrelevant for them. What's relevant for them is the returns on capital. And as we can see, if they can buy for a good enough price and they can get enough free cash flow out of the business, well, actually, it's a pretty good investment. The next thing to understand is the decentralization of Constellation, which is crucial to the thesis. Constellation is separated into 6 operating groups and is heavily decentralized. The idea is to delegate capital allocation by teaching everyone the culture and the investment philosophy, and then the most efficient and best branches at allocating capital will be given more cash. and vice versa. The CEO and the high-ranking executives, they only supervise the very big acquisitions. This decentralization strategy is great because it makes for a much more efficient, fast decision-making and makes it much easier to scale. And it's thanks to this that they've been able to acquire hundreds of companies each year. In addition though, Constellation is the type of owners that all companies would like to have. They have a reputation for buying companies and holding them forever. It's not like a PE firm that might buy your company and instantly fire 40% of the workforce just to try and get the most money out of it. Constellation is there to work with the companies, preserve the culture, and keep some morals. And one last thing I'd like to mention before we move on to the risks is the amazing culture that there is among Constellation, thanks to what Mark Leonard built. Firstly is how they communicate with investors. For most companies, the typical quarterly results are generally filled with buzzwords of, this was an incredible quarter, incredible year, we broke records, blah, blah, blah. Now, you won't see that here. Constellations have always said that they prefer focusing on running the business rather than waste time on these kind of things, answering to investor calls and presenting results and things like that. They don't do earnings calls, they don't give out guidance, they don't try to sugarcoat things. They're also very intellectually honest when they communicate with investors. They're essentially just true owners, and they just let the results do the talking. The best example of this is when the whole AI debate started, they organized an extraordinary investor meeting where they essentially explained how they saw the situation from inside. And essentially what they said is, like I said, they were very intellectually honest. They essentially said they just don't know how this is going to turn out. They don't know how it's going to turn out, but they're doing everything to incorporate AI within their company. And they said that they don't really see any true benefits yet. And honestly, this is so refreshing nowadays where you just have executives, just always telling you good things, that nothing is going bad. And to me, it gives me a lot more trust in them. Another great example of the above culture at Constellation is how they deal with stock-based compensation. At the company, they haven't issued a single share since IPO. Instead, what they do is they pay their employees and they force them to buy a certain amount of stock in the company with that money. In the world of software where stock-based compensation is so huge and plays such a big role, it's so refreshing to see someone being honest about it. All the other companies tend to treat stock-based compensation in a pretty perverse way. They tend to adjust it out of the metrics they report as if it weren't a real cost. And the thing is, they do so much stock-based compensation that in many times, when you include the stock-based compensation, it's enough to turn them unprofitable. In fact, as we'll see along the video, this is a crucial point, especially for valuation, because many of these SaaS companies that have fallen, they keep adjusting stock-based compensation out of their metrics. But in fact, if you include stock-based compensation, then many of these SaaS companies that look cheap on paper actually aren't that cheap. Now onto the risks. The first risk stems from the fact that AI is becoming so good that actually now new companies or existing companies might be able to vibe code software, which means that Constellation is going to have a lot more competition because these companies can vibe code the software and they can provide it for cheaper. But also companies might actually decide to code their own software in-house instead of using Constellation software. So first, let's take a step back to understand the nature of Constellation as a business and whether this risk is genuinely justified. So first of all, the characteristic of the good and service provided here is, well, first of all, it's mission critical to customers. Second of all, it's a small cost relative to overall expenses. In many cases, it even counts for just 1% of their costs. Third of all, the software tends to be highly personalized with high switching costs. This tends to be software that companies have been using for decades that is specifically personalized for their workflows and for their company. And so it's not something that you switch from one day to another. And so essentially, and this is a verified statistic within Constellation, customers just don't leave unless they go bankrupt. That's about the churn rate that Constellation has. So the crucial thing to understand here, what I've been pointing towards, is that the software itself is not the value proposition. There's a concept called Maslow's hierarchy of needs, which basically explains that humans have needs arranged in levels, and you generally need to satisfy lower levels before higher ones matter. So to make it short, I think that this idea is really relevant here because it helps us understand that for a company, the most important need is for the software to work, whether it's reliable and won't break down so that it doesn't interrupt your business activity. And only then does costs and additional features come into play. Now, let's also think about rival companies being able to vibe code software, making it much easier to create it and cheaper to provide. For a competitor to be able to compete with them, it means that, for example, a startup that is going to vibe code software, that part is fine, but the difficult thing is they now need to hire a whole sales force to be able to go and meet all these small companies and be able to build this distribution network to even be able to sell their software. So let's say that the distribution network is now set up for these startups. Now we need to talk about the actual service or good provided. The main question is, okay, so what's in it for the customer? That's the main question. What's the value proposition that these new companies can come to the customers that would justify them switching? Peter Thiel said something really important about innovation. He said that something is truly disruptive when it's 10 times better than what already exists. Not just 2 times better or 3 times better, it needs to be 10 times better. Because otherwise, there just isn't enough value that justifies the customer switching. Remember, the main needs are already satisfied. First of all, the software already provided, like we said, doesn't actually cost much to begin with for these companies. Perhaps 1% or perhaps a bit more of their overall costs. And even then, if one of these companies approaches a customer and says, okay, we can provide a better software, you just need to switch, well then what the customer might say is, well, first of all, if there's an issue with the software and someone needs to come and fix it, are you coming to fix it? Do you have a whole team that can be deployed anywhere around the country that can come help and fix whenever an issue arises? Because these small companies, like for example, a dental clinic or an asset manager or a farmer, they can't afford to lose business because their software isn't working. They don't want to go through the massive headache that it might be to switch something that is already working when the alternative might have plenty of issues and you don't even trust or know if the provider can come help you fix it. Also, remember that the software needs to work 100% of the time. Not 99% of the time, 100% of the time. If you're saying that the software provided is vibe coded, so by, for example, a large language model, remember that these models are non-deterministic, which means that in a sense, they sort of guess the next thing. And so this means that it's prone to have a percentage of error. And so again, especially think about the heavily regulated and those businesses that need a lot of compliance. Even 1, 2, 3% of mistakes is not acceptable for them. And even if it is, if the current one doesn't make any mistakes, why would they bother switching, ending a multi-decade relationship just for something that might not work and that you don't even know if they can come and fix it? So to sum up, what I'm trying to say is that all the needs are currently being satisfied for these customers. So unless you come up with something that is truly amazing, I doubt that they'll switch. And again, with regards to the fear that customers might vibe code their own software in-house, it's the same response. Why would they bother doing all that instead of focusing on their main business, which is to sell whatever good or service they provide, and have to deal with something that may have many issues that they just don't know how to fix? Why would they do that? There's no point. And one last thing I'd like to mention about Constellation's moat is actually, the technical know-how, the industry knowledge they've accumulated over the decades of dealing with hundreds of companies, even thousands, and also the data they've accumulated. If anyone is going to be best positioned to benefit from AI, it's someone like Constellation that has been in the industry for decades, that has all the data needed to train all these models as best as possible, and that has the whole distribution network already and the employees to deploy everything efficiently. Because we must recognize that there's always this possibility with AI evolving so fast that one day, you have some sort of model that is genuinely amazing. But that doesn't worry me too much. Because like I've been saying, the software itself isn't the value proposition. I think that the moat isn't in something that AI can replace. What makes Constellation successful is its distribution network, the industry knowledge they've accumulated, the high switching costs of the service it provides to companies, and the data they've accumulated. The second risk that's heavily affected the stock is the fact that Mark Leonard had to step down because of some health issues. And of course, given the reputation he has of being called the Warren Buffett of Canada, which he deserves, and the fact that it's mainly thanks to him that Constellation is where it is today, it's justified, I think, that people are a little bit scared. However, first of all, like we said before, Constellation is very decentralized. So it never relied on Mark Leonard to carry out all the acquisitions. They would only carry the big acquisitions. And the person replacing him, Mark Miller, has been with Constellation for about 30 years. So I think in all likelihood, I think he's a man that's up to the task. He comes more from a product developer background, which I think could be a benefit given the changes with AI. So overall, I think that Constellation, in all likelihood, can continue to do well without Mark Leonard. But of course, it still remains a risk that, perhaps some of the big acquisitions might not go as well because he's not there. However, the third risk, which I'm much more preoccupied personally about than the first two risks, is the fact that Constellation, as it grows, finds it increasingly more difficult to deploy capital at high rates of return on capital. Essentially, due to their size, the same issue that Berkshire has, well, Constellation has it as well. They can keep buying these small companies, but given their size now, it doesn't move the needle as much. And so either they lower their returns on capital or they have to try and make bigger acquisitions, which carries more risk. And, this is a natural thing anyways. I mean, it's unavoidable for this to happen as you grow in size. And in fact, we have seen returns on capital fall as is expected. However, they have been focusing a lot on trying to address this issue. And the solution essentially is to try and make 1 or 2 big acquisitions per year. That would be enough for them. And so they've been doing those. Encouragingly, in their most recent quarterly results, they've announced that they're pursuing a new strategy called PEMS, which is Permanent Engaged Minority Shareholders. This strategy is going to help them deploy capital to ensure they have a long runway. Essentially, Mark Miller, the new CEO, said that this was developed in conjunction with Mark Leonard. And to make it simple, this strategy is basically about buying minority stakes in publicly traded companies and partnering with them to help them operate successfully. This expands their TAM massively and is actually pretty good news. But of course, you always have this risk of execution risk. Are they going to be able to find the good and the right opportunities at the high returns on capital? So overall, we've gone through the business and its risks. And I still think there's a few weaknesses that we have to mention about Constellation, that it's just this thing where you either accept it and you invest while knowing this, or it detracts you from investing. So first of all, you have this AI disruption, which I think, being intellectually honest, to an extent, we can't know how it's going to pan out. And perhaps as an investor, you might say, well, I don't need to try and guess whether how this is going to turn out. I can just focus on things where I have a lot more certainty, and perhaps that may be more in my circle of competence. But second of all, moving away from all this AI debate, one thing about Constellation is that it's an acquisition-led growth strategy. So this means that in terms of accounting, it's much more difficult to understand Constellation. Their financials are more difficult to understand because this acquisition strategy means that many metrics, like for example earnings or free cash flow or things like that, can be distorted from one year to another massively. The second thing I'd say is that, like we've said before, you kind of rely a little bit on the culture and on the M&A knowledge to carry on being as good as it has been. With this new strategy as well, the PEM strategy, we're kind of stepping into unproven territory. So again, this is another risk, because you might say, well, buying minority stakes in publicly traded companies is not exactly the same thing. So maybe it might have a higher risk of going wrong. And finally, I'd say also one of the main things that isn't talked about as much within the whole AI debate is that I think an important part is, can Constellation execute AI within the company successfully? I think all these companies may be very resilient, but they also need to adopt AI to enhance their activities. And so again, you have this risk of, can they execute on that? Now, in terms of valuation, we must use a metric called free cash flow to available shareholders. This is the metric that Constellation uses to judge its business and essentially adjusts out minority interest, since free cash flow is on a consolidated basis. This is an example of what I was saying before of how the accounting is a little bit nuanced at times. And so this is the metric that you should use to value this business. Now, using this metric, at the time of recording, the company is currently trading at a multiple of 21 to 22 times. Now, I think most people will agree with me when I say that Constellation, before this massive drawdown, was a stock that was very expensive. It traded at a premium because of the many factors that we've seen before. So overall, I think that this drawdown has been pretty healthy for the company. And I think that now we're looking at an opportunity to buy a great company at a reasonable price. If Constellation keeps growing anything close to what it was growing at before, then a low 20s multiple is not much. And you might be disappointed if you expected me to go more in detail with perhaps a DCF or a more advanced valuation. But my philosophy in investing has always been that I prefer being directionally right than precisely wrong. To me, if I can't say in 5 minutes whether this business is cheap or reasonably priced, then it's probably just not a good opportunity. And with Constellation, I think that if the assumptions that we said before and the analysis is right, then it doesn't matter which metric you look at it from, then it's trading at a pretty reasonable price, and you could even say a cheap price. But of course, the crucial thing is, do the assumptions that we said before hold? So overall, like I said, I don't really buy into this AI risk, And I think all the other risks that there are pretty manageable overall. And so even though I don't think that the stock is trading at a bargain price, I think it's, if anything, pretty reasonable price. And in fact, I think that if most of the assumptions hold that we said before, you could even have a margin of safety. A low 20s multiple for a company growing at high double digits or even in the 20% is pretty good price. Overall, I'm carrying on essentially for the company to not change. I'm counting on the culture of Constellation to remain, and I'm counting on them to be able to keep deploying cash at reasonable returns on capital like they've done in the past. And if that happens, then I think that paying a low 20s multiple, then we should get a pretty handsome return over time. Overall, this is a company that I'm happy to hold for a long time, a few years, of course, if nothing changes. So let me know down in the comments what you think. I'm pretty interested in what you guys think and if you think there's any flaws in my thesis. And yeah, like and subscribe and let me know down in the comments.